Well, Andrew Popper is the Chief Investment Officer at SG Hambros Bank. He's responsible for around £10 billion of assets. He joins me in the studio now. Good to see you, Andrew. Thanks very much indeed for coming in. So are you optimistic about the performance of equity markets in the year ahead?
Yes, I'm still optimistic. I think at the very least they should deliver normal returns, which means around 8 to 10% on average. We had a good year in 2010, and the good year in 2010 rested on, I would say, two pillars. One, very solid corporate earnings and a very healthy financial situation at a corporate level. And second, very accommodating monetary policies. So the two pillars will remain in place. So therefore, we have a relatively optimistic scenario for equities moving into 2011. But of course, one has to become a little bit more worried when you already see the market having discounted a lot of positive expectations.
So is there enough of a basis then, or a foundation for investors to be putting their money into riskier assets?
Yes, definitely, especially since they are getting punished for being in cash. So the move towards riskier assets should continue. We're looking at equities as presenting a positive outlook, and also other asset markets as well, especially commodities, gold included. We're certainly not in a deflationary world. The risks of deflation are probably negligible on a global scale at this present time. So what we are looking from the point of view of monetary policies and inflation is a moderately inflationary outlook, and that usually bodes well for riskier asset classes.
Now, you said that the market has ignored some positive signs. What does that mean? Can we expect some fairly sharp corrections along the way?
Market had ignored positive signs earlier in 2010, especially in the middle of the year. There was a lot of discussion about a double-dip recession, about a poor outlook for equities, about a possible equity bubble. So in the middle of 2010, the market had discounted a lot of negative news. What is to some extent worrisome is that all the good news have been already reflected in the price. So one has to be positive on equities and other asset classes, in my view, but a little bit more careful, given the fact that we have already regained a lot of the lost territory.
A number of the people that I've spoken to are saying that some of the biggest challenges this year include Chinese inflation in China, not just a threat to that country, but to global markets.
Well, definitely China is a concern in the sense that they are having to confront the risk of inflation. And the concern is that if they tighten their monetary policies, that will have an impact on global growth and global demand. However, one has to wonder why aren't they doing the obvious, which is to allow their currency to appreciate. What is appearing increasingly obvious is that their policy of maintaining an artificially low currency is hurting their own economy in terms of inflation. So it's in China's interest, in my view, to allow their currency. So are they more
likely to let it rise?
I suppose so, because it's very obvious that it's not in their interest to maintain this artificially low currency. It's hurting the outlook for inflation. It's forcing them to take measures that are going to hurt their economic growth, where the correct solution would be to allow their currency to appreciate. That's the best way to combat inflation in their case.
Right, well, great to get your thoughts, your perspective on this. Andrew Popper, Chief Investment Officer at SG Hambros Bank. Thank you very much indeed for coming in.
Thank you.
Good to talk to you.